Hello and welcome to episode 10 of the Special Situations Report, a podcast by Inside Arbitrage, covering the most intriguing event-driven activity over the past week.
My name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. Special Situations activity kicked into high gear last week across the spectrum, whether it was new mergers and acquisitions, very significant insider buying, notable C-suite changes, or buyback announcements. This week, we will briefly discuss the acquisition of Redfin by Rocket Companies, Beacon Roofing Supply agreeing to sit down and finally have talks with QXO, the appointment of Lip-Bu Tan as the new CEO of Intel, and the departure of the CEO of Asana, a big spike in insider buying, including by the CEO of First Citizens Bank shares, the upcoming spinoff of Angie by IAC, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
Let us kick off this podcast with some positive news on the developing M&A front. Beacon Roofing Supply finally agreed to come to the table and have talks with QXO after refusing to engage with them for months. The stock immediately moved up more than $7 per share and is one of the new bright spots in an otherwise dismal market environment. QXO had reported earlier in the week that it was extending its tender offer to acquire shares of Beacon to March 14th and that 18% of outstanding shares had already been tendered.
As we mentioned in prior podcast episodes discussing this deal, Brad Jacobs is not one to back down from a battle. The other potential deal news was TXNM Energy, a utility that provides electricity in Texas and New Mexico and was previously known as PNM Resources. And that company is exploring a sale after receiving takeover interest from a potential suitor. The company's former and current names both stood out to us as they looked quite familiar. The current name, TXNM Energy, is essentially the abbreviation of the states Texas and New Mexico where the business operates. Its prior name, PNM Resources, may be recognized by some merger arb investors because Avangrid announced an $8 billion acquisition of PNM Resources in October 2020, but after a long, drawn-out regulatory process, the deal failed in January 2024 due to the New Mexico Public Regulation Commission voting to reject the deal.
I still remember following the twists and turns of the deal for years on end. This is one of the pitfalls of getting involved in deals related to insurance companies, utilities, and banks. There are multiple regulators involved and they often drag their feet. Speaking of regulators and positive news, the small bank First Financial Northwest that is based in Washington state and was in the process of getting liquidated following an acquisition of its assets and liabilities by, get this, a credit union, finally received regulatory approval from the National Credit Union Administration.
The stock jumped up nearly 16% last Thursday after both companies indicated that they expect to complete the asset sales early in the second quarter of 2025 and then distribute the proceeds to shareholders of First Financial Northwest.
This positive news related to both Beacon Roofing Supply and First Financial Northwest is one of the reasons I like to invest in these kind of situations. They will generate proceeds that can either be redeployed into another special situation or at times of market turmoil like the one we are currently experiencing into other long-term investments that are now trading at attractive prices.
But not all news is positive. Another potential deal that is no longer on the table but is still worth mentioning is Logility Supply Chain Solutions. The company was already in a $443 million deal to be acquired by Aptian for $14.30 per share in cash, when they received an unsolicited, non-binding proposal from an unnamed third party for $15 per share about 2 weeks ago. Logility decided this new offer could likely lead to a superior proposal, but just after a few days, the unnamed party withdrew its bid, so lots of mysterious business going on there. Bidding wars after a deal is announced can create excitement and unexpected windfalls for arbitrageurs, but that was not the case here.
It was very strange to see them make an offer. The company decided it was a superior offer. We expected that they'll walk away from the current definitive merger agreement and pay a termination fee, but instead, the person making the offer pulled back. Such a strange situation, as you just mentioned. Wrapping up our deals in the work section of this podcast, we saw the 23andMe saga continue with another twist to the proposed deal. So after New Mountain Capital walked away, founder and CEO Anne Wojcicki has come up with a new offer, this time consisting of 41 cents per share in cash and 3 contingent value rights or CVRs that together could be worth as much as $2.53 per share. As is normally the case with CVRs, there are 3 milestone payments extending out to fiscal 2028 associated with these CVRs. She's also offering to provide the company with a $30 million loan at a 7% interest rate and an additional $20 million to fund 23andMe operations.
Continuing on, the biotech Acelyrin announced that in response to Tang Capital Partners' continued rapid accumulation of 8.8% of Acelyrin's outstanding common stock, its board has approved the adoption of a limited duration stakeholder rights plan. Under the rights plan, the company is issuing 1 right for each share of common stock as of the close of business on March 24, 2025. We've talked about shareholder rights plans, also known as poison pill provisions, in prior podcast episodes, and I recommend you check that out if you're looking to learn more about them. In fact, just weeks ago, Beacon Roofing Supply, which we discussed earlier, had adopted a poison pill provision to fight off the QXO acquisition.
Since we like to weave in Elliott management into most of these episodes, it is worth mentioning that Emerson Electric was able to complete its acquisition of Aspen Technology at its originally agreed to price of $265 per share in cash, despite opposition from Elliott management that the price was too low. I'm not sure if they'll be able to still fight them in court, but for now, that deal has closed.
Switching gears to new announced M&A activity, there were 5 new deals announced last week, including 3 deals over $1 billion and 2 were microcap deals. We'll briefly touch upon 3 of them.
A couple of years ago, I got a chance to meet with the CEO and the chief operating officer of Benzinga in Detroit, and I remember them telling me that the mortgage originator, Rocket Companies, was situated in the same building that they had their offices in. I was familiar with Rocket Companies because for a short period of time, a few years ago, I had invested in the company. The investment did not quite work out well, and I exited when I realized that mortgage originators were likely to be in an extended period of weakness. Last week, Rocket Companies announced that it was acquiring the online real estate listing and brokerage company Redfin in an all-stock deal worth $1.75 billion, or about $12.50 per share at the time of announcement. The premium was a very healthy 115% from the prior day's trading price. And if you looked at a 30-day average trading period, it was a premium of 59%. The deal is currently trading at a spread of 10.15% or almost 19% annualized. This is an attractive deal, but since this is a stock deal, an arbitrager would have to short the stock of the Rocket Companies to capture the spread. Again, just to be clear, we're not recommending anyone participate in this deal or short any stocks.
The second deal we wanted to discuss today was Toyota Tsusho acquiring the Oregon-based Radius Recycling in a $30 per share all-cash deal worth $1.34 billion. Toyota Tsusho is a Toyota Group company that supports Toyota Motors' automotive business, and one of its business divisions focuses on metal recycling. The deal is trading at a spread of 7.87%, or 9.88% annualized because it is a cross-border deal and there are concerns about review by CFIUS, especially after what happened to the acquisition of US Steel by Nippon Steel.
I would be surprised if CFIUS would stop a deal like this, considering Japan is an ally, and at the end of the day, this is not necessarily a steel producer, but a recycling company. On the smaller side of things, another ally of the US, India's Sun Pharmaceuticals, is acquiring Checkpoint Therapeutics in a deal with $4.10 upfront cash payment and a contingent value right or CVR that could be potentially worth as much as 70 cents per share. The CVR payment is tied to the approval of Checkpoint's drug for the treatment of skin cancer. The drug was already approved by the US FDA in December 2024, and this CVR is related to the approval of the drug in the European Union or in specific countries in Europe.
The Checkpoint's Therapeutics deal is honestly quite small. The total closing value is just $355 million, but given that the company is trading below the cash price, not including the CVR, we found it quite interesting. That being said, that was a very jam-packed M&A section. Let's move on to spinoffs.
On the spinoff side of things, there's only one spinoff we wanted to talk about this week, and that was about IAC spinning off the rest of its stake in Angie. IAC, the firm created by Barry Diller, that has spun off a large number of notable companies that are household names like Expedia, LendingTree, and Match, is now fully separating Angie from the mothership through a special dividend. Angie is the home services company that went public through an IPO in October 2017. The company hasn't quite found its footing, and the stock is down an astounding 88% over the last 7 years.
This is another IAC company that has not done well post-IPO, with Vimeo down 90% since its IPO and Match down about 43% over the last 5 years. The Angie distribution will occur on March 31st, 2025 to IAC shareholders of record as of March 25th, 2025. About half a share of Angie will be distributed for every IAC share owned.
The other key change that will occur along with the spin-off is that IAC's CEO Joey Levin will step down and become the executive chairman of Angie. It looks like Barry Diller will take a more active role in IAC once Joey Levin steps down. IAC is another one of those sum of the parts valuation situations that hasn't quite worked out, but with Barry Diller involved more closely, I might take a closer look at IAC again.
Just like with everything else in the special situations world last week, stock buyback announcements went into overdrive even as the markets corrected sharply. We added over 30 buyback announcements to the Inside Arbitrage database in a single week. Let's discuss 2 of these announcements. American Eagle Outfitters decided to follow in the footsteps of Abercrombie & Fitch and announced a 50 million share buyback that worked out nearly to $575 million, or 26% of the company's market cap at announcement. American Eagle Outfitters only scores a 53 on our IA score, and the stock has lost more than half of its value over the last year. Earnings were weak the last 2 quarters, but full-year results showed growth both in revenue and the bottom line. If you don't take capital leases into account, the company has net cash on the balance sheet. The strength of the balance sheet, combined with the valuation where the forward PE is just 7, makes it clear why management has decided to initiate such an aggressive buyback. It is worth noting that retailing is incredibly difficult and very much subjective to changing fashion trends.
Another buyback announcement worth mentioning is by Churchill Downs, which is the home of the Kentucky Derby and operates a total of 29 casinos and racing tracks across 14 states. I was quite surprised to see this company and learn more about it when it showed up as a buyback announcement in our list. The company decided to buy back $500 million worth of its shares, representing 6.4% of its market cap at announcement. Revenue grew 11% last quarter to $624 million, and the company trades at a forward PE of 16. As you would expect from an outdoor racing business, it is a seasonal business with net margin in Q2 jumping to over 20%, and then coming back to the teens in the other quarters. They have repurchased 7% of their shares outstanding in the last 4 years, but considering they have nearly $5 billion of debt on the balance sheet, I sometimes wonder if they would be better served by paying down some of that debt, considering the stock is up nearly 200% over the last 5 years. So a strange time indeed to do a buyback.
Churchill Downs is a very unique company, and I think that's one of my favorite things about the special situations world is that you get to find these really, really unique and interesting companies. Insider activity is another way that we find unique companies, looking at insider purchases every single night. And last week, insider activity did not disappoint. To provide some perspective on just how elevated insider activity was, in our daily event-driven monitor for Friday, we reported insider buying in 47 different companies. This was just on one day. Over the course of the week, we reported insider buying in nearly 150 companies. The buying was broad-based, but we did see elevated buying in both regional banks and the energy sector. This reminds me slightly of the elevated buying in droves by insiders following the failure of Silicon Valley Bank, specifically by regional bank insiders. But during those times, we would nearly see 80 purchases in a single day. So we haven't quite reached those levels just yet.
Yeah, and we haven't reached the crisis levels in a specific sector like we saw after Silicon Valley Bank failed or across the entire market in March 2020. So maybe that is yet to come. Hopefully not, but it's possible. We'll quickly cover the two most interesting insider purchases from the last week. We saw two different insiders of the temporary storage solutions company WillScot Holdings buy shares, including the CEO and the chief operating officer. WillScot was previously called WillScot Mobile Mini after it acquired Mobile Mini in 2020.
We're familiar with WillScot because last September it decided to terminate its acquisition of McGrath Rent Corp in a $3.8 billion deal after trying for several months to get the deal approved by regulators. Instead of continuing to remain distracted trying to get the deal to the finish line, they decided to move on and paid a $180 million termination fee to McGrath. They also announced a $1 billion buyback program, and it is good to see that the insiders are buying shares as well. The company will likely not screen well for a few quarters because the big loss in Q3 2024 was related to the termination fee they paid for the failed acquisition.
I like to see companies that might not screen well because of a one-time event that hits the financials. So let's see how things look for this company after a few months. The second insider purchase worth mentioning was by two different insiders, including the CEO and the CFO of the bank First Citizens Bank shares. As you know, I presented First Citizens as an idea at ValueX Whale nearly 2 years ago, shortly after the company received a sweetheart deal to acquire Silicon Valley Bank after its failure. I had calculated that following that transaction, First Citizens was trading below tangible book value and presented an attractive opportunity. The stock rallied from around $1,300 back then to well over $2,300, but has come back down to the $1,800 levels.
We're used to seeing the chairman and CEO, Frank B. Holding, purchase Class B shares as compared to Class A shares, and I'm assuming that happened again this week, right?
Yes, you're right. So he picked up Class B shares at just under $1,500 per share. And the odd thing here is that Class B shares have higher voting rights. And one of the key reasons they trade below Class A shares is because they trade over the counter and not on the NASDAQ like Class A shares. I remember more than a decade ago, I used to watch his dad, Frank B. Holding Sr., purchase shares of First Citizens. And that was how I first came across this company.
It's a very long history of insider purchases there, going down the family line as well.
Indeed.
Quick coverage on the activist side of things. The hedge fund Anson Funds is gearing up for a boardroom fight at Match Group and plans to nominate several directors to the online dating company's 10-member board, which would only add to the series of management transitions we've seen at the company since.
Yeah, it's interesting to see this happen right after Spencer Raskoff took over the top job there. Another situation with an activist involved, or in this case, two different activists that are involved, is US Steel, where Ancora Holdings has a position and they want the company to go ahead and terminate their deal with Nippon Steel, while Pentwater Capital, which also holds a large stake, almost 9% of the company, obviously wants the deal to go through because they are a merger arbitrage focused fund. Ancora had a very small position in US Steel compared to Pentwater's 9% stake, but the latest twist is that Ancora has added about $100 million to its holdings of United States Steel as the activist investor continues to push its case to replace the board and install a new chief executive officer to lead a turnaround of the American steelmaker.
With that all being said, as I always like to say, let's transition over to C-suite transitions. The biggest C-suite transition last week was the appointment of Lip-Bu Tan as the new CEO of Intel, following the departure of Pat Gelsinger last December. The stock reacted very favorably to this announcement and jumped nearly 15%. The market is hoping that he pulls off what Lisa Su did at AMD more than a decade ago, and the turnaround Larry Culp engineered at GE more recently.
Interestingly, both Intel, along with Pat Gelsinger, and GE, along with Larry Culp, were case studies in the management transitions chapter of my book. So depending on what happens with Lip-Bu Tan, I might have to refresh that chapter in a future edition. Lip-Bu Tan is no stranger to Intel, as he served on the board of the company for 2 years before departing last August, just months before Gelsinger stepped down. He spent 15 years at the semiconductor company Cadence Systems, including 13 years as its CEO, and has deep experience and ties to the industry. He was previously on the board of SoftBank, which took ARM public in 2023, and was also on the board of Hewlett-Packard Enterprise.
Lip-Bu Tan has his work cut out for him because it takes a long time to turn around behemoths the size of Intel and GE. Intel was already on the path of taking several actions to engineer a turnaround, including spinning off Mobileye and the potential sale or spin-off of its foundry business.
He seems to be a very smart person. I went and looked at his profile, and at one point, several decades ago, he actually picked up a master's in nuclear engineering from MIT. So somebody who was very close to technology, and I think hopefully he's the right person to turn around Intel, which is going to be a difficult task for any CEO. Another C-suite appointment worth mentioning is the appointment of Kathy Smith as the new CFO of Starbucks. This follows Brian Niccol jumping ship from Chipotle to Starbucks last September. Kathy Smith was with Nordstrom for a little over 2 years, and a decision to join Starbucks makes sense considering Nordstrom's is being taken private by the Nordstrom family and El Puerto de Liverpool, a Mexican omni-channel retailer that operates nearly 460 stores in Mexico.
We're going to wrap up our C-suite section with the unexpected news of Asana CEO Dustin Moscovitz's decision to step down from the CEO role as soon as the company can find a new leader. We have discussed Asana multiple times in the past, mainly due to Dustin Moscovitz's insider purchases of the company at elevated prices, as well as the appointment of Sonali Parekh as the company's new CFO last September.
Yeah, Sonali Parekh came over to Asana from Ring Central, where she managed to more than double the company's free cash flow. But unfortunately, the stock lost more than half its value during the 2022 downturn in tech stocks. Asana dropped 24% in a single day after reporting Q4 results and announcing Dustin Moscovitz's departure. I don't know if you remember this, but do you remember the time when Dustin Moskovitz used to constantly buy stock of Asana on the open market, at times at almost $100 a share? The stock is currently trading at $13.88 per share.
Yeah, Dustin Moscovitz's purchases were some of the first insider purchases I've ever seen. So interesting to see how that story ended.
Indeed.
And with that, we'll wrap up the 10th episode of the Special Situations Report. What we've covered today, as always, is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.